The expected has happened. As CNBC-TV18 reported, the Reserve Bank has released just a brief statement confirming that the unscheduled MPC meeting was held solely to discuss the fact that inflation was not within 6% for 9 months in a row, and what would the report be that they would write to the government. Well, to be fair, while we broke the story a week ago, the RBI governor did confirm it at the press conference earlier this week. Let's hear him out.
Today, we are in a situation where, the inflation has remained above 6% for 3 consecutive quarters, and under the accountability norms which are provided in the Reserve Bank of India Act, we are expected to send a report to the government. I don't have the privilege, authority, or the luxury to release it to the media before even the addressee gets it. That is not to assume that the contents of this letter and the report are going to be perennially, under wraps. They will be available in the public domain at some point.
Okay, so that's where we start the discussion today. We are going to get the contents at some point in time, but we do know that the report written by the RBI to the government will have the following 3 points. 1, it will cover why RBI failed to keep inflation within 6% for 9 months in a row. That's a long time. 2, what remedies is it taking? And 3, by when will it bring inflation to target given the remedial measures it's taking? Okay. Now, today I have with me 3 experts to discuss what may have been RBI's answers in that report, and how are these likely to have been impacted by what happened just recently, the FOMC turning more hawkish than expected. And of course, the impact of all this on the future course of monetary policy. I have with me Samiran Chakravarti, Chief Economist for Citi India, Soumyakanth Ghosh Group, Chief Economic Advisor at the State Bank of India, and B. Prasanna, Head Global Markets Group at ICICI Bank. Gentlemen, thank you very much indeed for joining us. Well, I thought the November 3 date selection was purely coincidental. Samiran, do you think that it is deliberate? The report that RBI has written or will write would have been influenced by what the FOMC decided?
Thanks, Lata. Well, if you see how the governor has characterized the global situation in the September 30th policy, it quite clearly came out that he mentioned this rapid interest rate hikes and strong forward guidance of global developed country central banks as the third storm. So to make the letter stay fresh for a slightly longer period, RBI probably wanted to draft the letter after seeing what the Fed guidance would have been. And in turn, it has turned out to be quite justified, because compared to what the market perception of the terminal rate pre-FOMC was, the post-FOMC that has shifted up by 50-75 basis points. So in some sense, then whatever global backdrop this letter is likely to provide, that global backdrop will be more current now based on FOMC's assessment.
Okay, fair point. So I didn't believe that, but now it makes sense that the Reserve Bank would have wantonly chosen November 3rd so as to at least know what is the biggest central bank in the world doing before it drafts that report. Okay, now let's come to the contents. Section 45ZN will run for you as we speak. The first thing is, why did RBI and the MPC fail to keep inflation below 6% for 9 months? Soumyakanth Ghosh, do you think this will be the boring part of the letter? It's guessable, or do you think even in this, when the letter is released, you will look for some important revelations?
Yeah, thank you, Lata. I think the governor has also emphasized repeatedly, I think in the last policy also in the press conference, that this is because of external developments. One of them was the pandemic, the second one is Ukraine war, and the third one is the unprecedented tightening by the central banks, including the Fed. So I think, given this context, I think the Reserve Bank is likely to list these unprecedented developments on which they actually have no control. Because if you look into the reports carefully about the exchange rate movements in terms of dollar appreciation versus rupee depreciation, I think these are mostly external developments where the central bank has no such control. So my sense is that it will list out the measures where it will clearly say that these are the factors which are not controllable from a central bank perspective. So that would be the bottom line of the report, if I guess so rightly.
But what do you think, Prasanna? Do you think that, Dr. Verma had been giving the impression that the Reserve Bank should have tightened or become a little more hawkish in prior, now of course he's dovish. Do you think something in terms of demand, aggregate demand, may also find its way into the report, probably on Dr. Verma's insistence? After all, in the last 30 months, for 20 months, inflation has been above 6%. It's barring these 9 months in a row, even before COVID, there have been several months when it was above 6%. So do you think aggregate demand being very high could also make its presence as one of the reasons?
No, I think, Lata, I would kind of tend to agree with my colleagues on the panel, because basically I think very clearly Governor, I would call it, came out with all guns blazing yesterday when he actually justified the reasons as to, I mean, not exactly the reasons, but the kind of actions that they have taken. And he actually said that there is no way to evaluate the counterfactual, which is to say what would have happened if they had, hiked a little earlier, because we were actually just coming out of COVID crisis, which is not just a financial crisis. I mean, it's obviously a health and economy-related, jobs-related crisis. So I guess that I think is going to be the primary reason. And then, of course, the most important thing that the governor himself mentioned was about the Ukraine war on 24th, which led to a lot of supply-side related reasons. So I think these are the two things which I feel.
All right. So that's not going to give us. I think what remedies they will take could be a very interesting answer. Samiran, if and when that letter is released, will we get a very good idea of whether it's entirely front-loaded or whether there is a lot of work to be done? Would that be an important paragraph?
Well, the way till now the RBI has looked at things, they have quite clearly stayed away from giving too much forward guidance in a world filled with a number of uncertainties. So at this juncture, while drafting the letter, it would be very difficult for them to lay out an exact path of how the policy response function is going to be. But one can clearly say that they will articulate the fact that whatever the COVID-related easing of monetary policy has been on both rates as well as on liquidity, that has now been practically fully reversed. Now, whether they will use the Powell kind of language of saying that we need to go to restrictive territory to control this inflation, that will be something interesting from my side to see. But otherwise, it's very difficult for them to give a precise quantitative target of how much more rate hikes or more liquidity absorption is going to be required to bring down inflation. For me, the more important part is going to be that are they going to just focus on inflation coming below 6%, or is there going to be a more active guidance towards taking inflation down all the way to 4%?
I thought that was a given. The part 3, and again, those lines will run for you, 45ZN. It clearly says, by when will inflation come down to target? Soumya, don't you think the RBI is almost tasked with saying when it will come to 4 and not when it will come to 6? Target is 4, isn't it? They have to give a time, don't they?
No, I think, Lata, it's very difficult to give a time in these uncertain circumstances. Look at all central banks around the world. Even Fed, which was actually struggling to get the inflation upwards of 2%, I think, in 2020, now it's having its hands full in terms of an 8% inflation rate. And given the fact that I think there are too many uncertainties, moving parts, global uncertainties. Now there are also domestic uncertainties in terms of a very unprecedented unseasonal rains which has happened in October, and if we all know how havoc it played to the inflation trajectory
Okay,
in
so
2019.
short point, you are not expecting when
Yes.
the letter is publicized in the public domain, you don't expect them to say that we will bring it down to 4
Yes.
in whatever 2024 or something like that. You don't expect them to say
Yes.
that.
I don't expect that amount. It can only say that we will strive to attain it and get it down in the inflation band, but not to the central midpoint of 4%, to be exactly specified.
You think so, Prasanna? I thought the rule was so clear. When are you going to bring it down to target? You're not even expecting them to give a timeline.
So Lata, I think the way I was looking at it is I actually, before the governor spoke yesterday, I was actually thinking that the contents of this letter is possibly not going to come into the public domain at all. But it seems very clear that, if that was the case, then I'm sure RBI could have, possibly given what they wanted to actually say to the government in much more in detail. But then if the assumption is that at some point of time, the government's prerogative to release a letter, and it is expected to come out very much like the minutes of RBI, the MPC meeting, in which case I think what also needs to be taken into account is what is it that the RBI wants the rest of the world or the market to, hear and see in the minutes. And if they want to be really transparent with the government and that ends up, coming in the public domain, they might end up saying much more than what they normally would like to say. Like Soumya Kanti was saying, that sometimes the central banks want to keep a lot of things close to their chest without
So are you expecting a timeline or not?
No, timeline, yes, because it can be an 18-month to a 24-month timeline.
You expect
but
they
whether
will
it
say
will be
that?
4%, I think so, because that is very clear. But then to say whether it's 4% or whether it's 2 to 6%, what actions they are going to take, I'm a little, frankly, a little confused on that as to how exactly they are going to word the letter.
But they will have to give a commitment as to when they will reach 4%, Samiran, or will they just be saying that it will come below 6 in a quarter? Will that be enough? I don't think 6 is possible, right? They have to say when they are expecting it to come to 4. Samiran?
So in any case, the RBI has an inflation projection out in public domain where they're calling for a 5.8% average inflation for the Jan-March 2020 quarter. So for them to repeat that statement will not be too difficult. There is nothing more that they're diverging to the market than they have already said. And in fact, even the 4%, RBI has indicated that over a 2-year horizon, they will probably reach that 4%, which they're not in a hurry to reach. Even repeating that, I don't think is that big an issue. So both the things can come in the current forecast of 5.8 by March, as well as the 4% over 18 to 24 months horizon. Both the things could be technically there on the list.
Okay, now to the more important question. Prasanna, would you say that after the FOMC's, or rather Jerome Powell's statements that, the terminal rate is likely to be even higher than what they thought, and now the market itself has moved higher in terms of its expectations, do you think the Reserve your expectations of hikes from the Reserve Bank have gone up? What are you expecting in December and later, a peak rate?
So I think, Lata, very clearly we have moved from higher, faster, longer to even higher, slower and longer. I mean, that's the way I would describe the Fed reaction. So basically we are looking at 5 quarter and 5 to 5 quarter, or maybe even 5.5, we don't know. And we are looking at these hikes to, come over a little more slowly than the kind of urgent rate hikes that they were doing earlier. Now, what this has opened up actually is that I think while the governor's press conference yesterday was quite soothing and, calming kind of a statement, I think there is no other option but for the Reserve Bank to, kind of go with the Fed in terms of the direction. I'm not saying they need to do a one-on-one increase in the policy rate. So even if you assume a 125 basis point rate hike by the Fed from the current levels, which means we are talking about something like 5 to 5.25. Even a 75 basis point rate hike from the RBI seems to be par for the course, because you can't let the interest rate differential to fall to too low levels. It's already on the lower side. So I would say that, yes, after yesterday, my inclination is to believe that the likely repo rate, terminal rate, or where they were likely to pause for some time has probably moved higher by 25 basis points from 6.5 to something like 6.75. And I'm inclined to believe that the next policy they will possibly would like to do 50.
Okay, Shaumya?
I more or less agree with what Prasanna said. I think one interesting, if you look into the press conference yesterday, if you look into the statements, the minutes of the meeting, they were a little bit dovish because it talks about, Powell clearly talked about the past rate hikes getting impacted. But in the press conference, the statements were very hawkish. So I think if I take the same logic over here, and given the fact that inflation, RBI inflation projection of 6.7% is likely to be understood, we are expecting that it could go up a little bit higher. 50 basis point rate hike for the December policy looks on course. There is always a scope that as the inflation gets down this year, then the RBI can look into the entire trajectory realistically. But as of now, if the Fed goes ahead with a 50 basis point rate hike, say in December, another 25 each, then RBI will have no option but to hike the rates incrementally. So maybe a base terminal rate of 6.5% and beyond looks the most likely option at this point of time.
Okay. Samiran, the Citi economist, I think, has, the global economist has, I think, upped their peak rate by 75 basis points. Any change in your peak rate expectations for India?
I think, Lata, where the markets are slightly confused is that the MPC minutes of the September meeting was somewhat more divided, where the couple of external members, they clearly articulated that the MPC mandate is only to look at the growth inflation balance and not so much on the external sector, current account, or the currency, for which RBI has other tools. So if you take that sort of a view, then it's difficult to justify why RBI will have to hike more than what we were expecting before. Whereas the other part of the committee tends to think that there is an indirect loop through the currency, which the exchange rate passed through onto inflation could make matters worse. And that's why there is need to do some kind of a preemptive hike in line with Fed. Whichever of these two arguments win will determine whether the terminal rate in Indian context would be higher or not. At this moment, we are still working with a 6.5% terminal rate, but we do acknowledge that the interest rate differential between Fed and RBI would become pretty narrow if RBI has to stop at 6.5. It would be a challenging task.
Okay. Well, the other impact, of course, will be on the currency. Take a quick break and we'll come back with questions on what may be the impact on the rupee, with the Fed turning more cautious, more hawkish than the markets were prepared for.
Love spaghetti.
Welcome back. We've been discussing with three experts what will be the impact of the Reserve Bank having to report to government the fact that they have failed. Will the contents of the letter weigh on them in policy making? And more importantly, the FOMC changing changing its language to become more hawkish, if not the FOMC, at least Jerome Powell. I've been speaking with Samin Chakrabarti, Soumya Ghosh and B. Prasanna. Gentlemen, thank you for your patience. Well, Prasanna, basically now, should we be prepared for more rupee weakness, considering that the FOMC has turned hawkish?
Lata, that's, I think, obvious if you leave it to market forces. Obviously, the rupee will be a little bit on the depreciating bias. Just take into account the fact that the dollar index went to 114, then appreciate and came down all the way to 110, and that was when the expectations of the slower rate trajectory from the Fed was getting factored in. But what was clearly not factored in the global markets is the fact that there will be a higher Fed fund rate as well. So now what this has done is since yesterday, since the Fed meeting, is that the dollar index is again started, appreciating, and which means that there will be a depreciating bias to the rupee as well. But what is clearly not known is what is going to be the extent of RBI's, intervention, and at what level they're going to be really coming in and protecting the rupee, if at all. And one would have to assume that since they have actually spent quite a bit of reserves in the last 6 months, they would probably not have that much or wouldn't want to use as much ammunition that they've used in the past. So I guess it's a little bit of both, let it depreciate a little, but also come in and, kind of prevent huge volatility while it's depreciating.
Okay.
Keep in mind that the current account deficit is very much on the higher side still.
Soumya, would you concur that the market, the Indian economy, business people, India Inc. has to be prepared for a slightly higher depreciation? Do you have any number or range in mind for, say 2023 or just for FY23?
No, I think the rupee will continue to have a depreciating bias, and I think this there has been a slight shift in the Reserve Bank strategy. I think the last 2 months when they allowed the rupee to weaken below 80, because the NDF market was already showing the rupee below 80 in August, but the RBI was holding until the end of September. So my sense is that yes, there will be a weakening bias in the rupee, but what is important to understand is that at the end of the day, how far the central bank allowed. So it will actually be a very delicate call between maintaining a value of the rupee and ensuring that at the same point of time, it has not significantly impact on the inflation. But my sense is that yes, there will be an impact on the value of the rupee.
Okay, for FY23 itself, should we be prepared for say 84, 85?
It's difficult to say, but one good thing, Lata, is that I think current account deficit last time was a positive surprise. And I think one of the factors which has acted as a counter-cyclical response to a deteriorating current account deficit was the private transfers. So if that plays out, we may get a current account deficit number which is higher than the market projections in more than 3.5%. Okay. The RBI is maintaining it at 2.8%. So that could be one of the positive surprise which could hold back the rupee depreciating to a significantly lower levels.
Samiran, the Bank of England has also raised by 75 basis points. So there is a tightening, a serious tightening bias the ECB has already done, and now the FOMC's peak rate is likely to be 5.5 or 5.25 or 5.5. Given that, should we be prepared for a higher current account deficit and therefore more pressure? Destination countries are tightening seriously.
On one hand, we have to deal with this somewhat unique situation where global growth is slowing down, but India growth is holding up. And that growth differential is causing our current account to stay relatively elevated. But on the other hand, in funding this current account, among multiple sources of funding, one particular source is going to be challenging, which is the ECBs and all, where whatever external loans will come up for refinancing going forward, there will be a tendency for people to try to shift from dollar into local currency borrowing, given that the interest rate differential has shifted quite a lot, and there is expectation of further currency depreciation, etc. So how then will you find the current account deficit, even if hypothetically current account deficit stays just about 3% of GDP? Would it mean that then the balance of payment deficit will continue much beyond FY23? And then what does RBI do on the FX intervention side? While all this is theoretically correct, one thing we should not forget is that RBI has not as yet started using any capital account measures on capital controls to restrict capital outflows, as well as encouraging more capital inflows. A central bank always has multiple levers to play with. So I would not be looking too far ahead to predict how this situation is going to pan out. RBI has pretty high number of levers to control the situation if it feels that the FX reserves has declined beyond the critical threshold.
Yeah. And they're, of course, approaching all this from a position of strength. It's not a back-to-the-wall situation at all. I mean, we are running out of time, but to come back to where we began this conversation, the RBI report to the government. Soumya, do you think that now the terrain in December could be very contentious? We know that two external members are pretty dovish. Dr. Verma wants it to stop at 5.9 or at 6%, the repo rate. But now, faced with what the Fed is doing, the RBI, as all of you are saying, is, there is an upward bias to the rate hikes. So does that make the December and subsequent meetings very contentious, with external members not bothered about, the rupee so much, and RBI, turning out to be more hawkish?
No, I think that's a very valid question. And the most interesting part is that the December Fed meeting is perhaps, I think, after the RBI meeting in December. So that will actually make the things even more complicated. So, but my sense is that it may not be, it may not be the appropriate to think of actually going for a maybe shorter rate hike at this point of time, because things are very uncertain. There could be rate hikes by the Fed in December, in February. So it is better to stay safe than to say sorry at some point of time. Because at the end of the day, we all know that what happened to US when they termed this as transitory inflation and then had to retreat and hike rates so as to contain.
Okay. Well, out of time. Samiran, will it be contentious? Very quickly.
You mean the letter or the policy decision?
The December meeting, because it looks like the external members are dovish, but RBI has other problems.
Yes, we have already started seeing a divided voting pattern in the MPC, so I'll not be surprised if that division continues in December.
Okay, we're out of time, but thank you very much for a very interesting chat. The important part is the FOMC's behavior, Jerome Powell's statements clearly indicating a higher terminal rate for the US Fed funds rate is likely to give an upward bias to the peak repo rate in India. And that has a lot of consequences for the economy. We wrap up on this edition of Indianomics. Thanks much for watching.